Conduct a cost segregation study and duration of the study. And then we will be quickly going over who we are and joined by today. And if you guys are not familiar, Miguel and I are always on these, but we are joined with Crystal Tripp. But just to go over who I am, I'm an account executive with our firm. So if you guys ever need anything, need any context in regards to our process with the cost segregation study, tax help in general, you can always reach out to me. I'll give you guys my email directly after this. And then, of course, we do have Miguel. He's our founder of Shared Economy Tax. And then Crystal Tripp here is our associate for SET. She really helps us drive the cost segregation study. If you see Tripp as the last name, some of you guys might be familiar with Mr. Mike. They are, of course, married.
Yeah. So, and let's do a quick surprising hobby of the panelists. We'll figure out. Jacob, you go first. What is a hobby you have that people might be surprised to
Oh
learn about?
man, it's a very good question. I would say that maybe not such a surprise, but I really like music. So I do play guitar, I play saxophone. So odds are on a Friday night, if it's a quiet one, I might pick up the good old guitar and jam out a little bit.
Brilliant.
What about you,
I can
Miguel?
attest. I can attest to that. We've jammed before.
We have,
On a late night guitar session.
yep.
Uh, I would say folks might be surprised to learn. I live in Austin, Texas now. That I used to surf, so
Mm,
I hung up. I grew up traveling with my dad, and we're from a coastal town. Like my folks are from a coastal town in Mexico, and we found out that I found out when I was like 12 that my family's from like this actual like secret surf spot that
mhm.
like folks who go down there and make like surf videos.
Yeah.
So yeah, I was an avid surfer and made my summer trips to Mexico, which I used to hate, by the way, and now I'm extremely grateful for him. And of course, my dad told me, he's like, "You're going to be really grateful for this
Of
when you get
course.
older." And I was like, "Nah, like all my friends are back home. Like, why am I
Hmm.
here?" So I just
Typical
surfed a
stop
lot.
teenager, right?
Typical teenagers. I have two, so now I'm just like, I haven't yet gotten to saying like, "Dad, I'm sorry." I'm certainly feeling that with my teenagers. Um, and then Crystal, how about you? So, well, welcome, of course. Happy to have you on, and
Oh,
surprising hobby for you.
thank you. A surprising hobby is I like to sew. It's kind of an old lady hobby, but I actually really enjoy it.
Yeah,
Okay.
sewing's kind of a lost art, I feel like too. I mean, if you ask me to sew a hole, cannot do it. So it's a lost, I think it's a lost art, to be honest with you.
It
So I
is.
know.
I am the go-to seamstress for the whole family. So
There you go.
Well, Jacob, that's how I know you weren't a Boy Scout.
I was not. Nope.
No, yeah, yeah.
Good
And
call.
Crystal, we can't see your video. It's okay if we can't figure it out, but just let you know.
yep. It's showing working on my end. So I think maybe we'll have to work with Lucy and see if we can add me in because I don't exactly know why it's not working.
All right. Well, that's okay. Well, let's get started. So, Jacob, take us on our agenda. What are we going to talk about today? Let's get into it.
Let's get into it. Yeah, so we're gonna of course start with our Q&A. We do have some questions prepared. If you guys have any other that we can get to, of course, go ahead and feel free to type them in the Q&A section. And then we're gonna get into more details about what the actual cost segregation study is. Of course, closing thoughts, main things to take away from this webinar, and then closing Q&A. So one last round of Q&A. So yeah, we'll get into it. Interesting fact of the day, guys. Okay, so the U.S. Federal Tax Code was 400 pages back in 1913. So we all remember that. And it rose up to 70,000 pages in 2010. So as you can imagine, more tax code, more scrutiny. We got to be careful, and we have to make sure that we understand the tax code in regards to our clients, what they're looking for, and really just our niche market being, of course, real estate, shared economy industry in general. Anything to add to that to Miguel? Not
Probably
really.
longer now. And true to tax fashion, we are referencing a year that was over a decade ago. We tend to do that.
Here's just a quick disclaimer, guys. Our lawyers insist that you read this. Essentially, hey, the exception might be you. This is general information, so please do not go act on any of this. Please seek out guidance from a tax professional and or law professional as well.
All right, so I think also true to format before, we want to get into some good questions just as we before we get into the content. That way we're engaging you up front and we're encouraging folks that follow us to submit questions before the webinar. So we take your questions and we organize them here and ask our panelist guests. So Crystal, these questions are for you. Question number one is, when you do a site visit for a cost segregation study, what are you looking for?
Perfect. So that's an easy one. Basically, I'm looking for the details of the home. So we want to go through and we want to capture as much of the qualities of the home as we can. There is, high-end properties, there's middle of the road. So we want to know where we are so that we can properly depreciate the asset. So I'm going to be coming through and asking questions just to kind of get a feel for the property, because sometimes it's hard to see based on photos. And I will ask all the questions so nobody has to get nervous. I know the questions to ask to get the right information out of you, so that's not something you have to worry about.
Thank you. And what has surprised you most during a site visit?
Not very much can surprise me. Little background about myself. I used to work for an appraisal company that did a lot of high-end properties in Manhattan and around the New York metro area. So I've kind of seen it all. So I've yet to be surprised. So I'll put that challenge out there if anybody wants to try to surprise me, but it takes a lot.
So kids and dogs are welcome during site visits.
Oh, absolutely. As the proud dog parent of two dogs that love to bark at the drop of a hat and a toddler at home, there's nothing that I can't get through. So kids and dogs are welcome on any site visits.
And let's talk a little bit about a site visit. I know we're going to get into it in just a minute, but these are the virtual tours that we do as a part of the analysis. And Crystal role, she facilitates those site visits as if she's there, but we don't physically go to your site. So having explained what a site visit is, what should clients prepare before a site visit?
So typically we want to have your Wi-Fi working very well, because we're going to be walking through the property like I'm there. And if it's spotty, I can't really see the finishes, so I'm not going to be able to ask you the proper questions to pull the information out of the homeowner. If we can also make sure that kind of everything's clear so we can walk through the property, I'm going to be asking questions about mechanicals. So you've got to be able to get to your laundry room or where your boiler is. Most people don't know where they are, so sometimes that's a good thing to know ahead of time. And then we're going to walk around. So if it's a rainy day and we're going to be walking around outside, then we should reschedule for another day.
Yeah.
If Wi-Fi is out, we're going to have to reschedule it, and that's fine, and we'll work around everybody's schedule. But that's the biggest challenge, I think, for these, since I'm not doing them in person.
Yep. And we did this on purpose, right? Crystal's camera doesn't work. Make sure your camera works, or we'll have to troubleshoot it. And things like this happen. So we do need to be able to visually see the property, and we want that good quality. So yeah, sometimes being on a cellular connection, the video is too pixelated and I can't refresh fast enough. So we want to make sure we are on a Wi-Fi connection. And I am curious, Crystal, what happens if maybe you do need to get to a property where the Wi-Fi is spotty? Can they maybe record a video after the call or something like that?
Yeah, absolutely. So we can definitely do a video recording. If there's something that I wanted to see, I can ask the questions. And then if there's more, then we'll just do it via email. There's pretty much nothing that I can't get most of the information from. if I see a good Airbnb listing. Because everybody has nice pictures on their Airbnb listings. So that's usually a good starting point for me.
Fantastic. That's awesome. That's great. And then the last question I have is, or sorry, no, the fourth question. What type of properties are eligible for cost segregation? What have you seen the most of?
So typically it's going to be single family homes. Um,
Mhm.
Most people are converting or not converting, but using single family homes as their Airbnb listings. So that is kind of our bread and butter. And that's pretty easy. We're just kind of walking through like you would your typical family home. Secondary would be duplexes. So if you're, townhouse or duplex, depending on what area of the country you are, that would be the other style that we see the most. And you kind of do it the same as a regular single family home.
Mhm.
Yeah, very good. That makes total sense. So duplexes, Airbnbs, VRBOs, and then the last one, I'm happy to help on this, but what kind of documentation is required for a cost seg study?
So I'm just trying to get as much information as we can. Um, Real estate appraisal is usually the best place to start out with. It's going to get me a lot of the meat of what I need in terms of your site size and certain features of your property. There's times where they fall short, where we might have to take some measurements the day of the site visit. So a tape measure is always welcome in case I need you to grab a couple measurements. Um, your Airbnb listing ahead of time is always something that I need. And if you've ever done renovations, if your contractor has an info sheet of what the finishes are that you put in, that's super helpful for me.
Amazing. So there you guys have it. We're going to present now on how we think about cost segregation and some technical considerations around it. Before we do that, we do want to give you a live link to our sign up page that if this is something you are interested in having a conversation on, certainly please stay for more information. But if you already know, based on what you've heard, that you want to have a conversation with our team, go ahead and grab this QR code in order to connect with us on a deeper, more specific level. And then just a note on Q&A, we will try to extrapolate kind of the general question. If a question is too specific, I do recommend that you set something up. The call is informational. If we do get your permission to describe how we work, we will continue to describe the service, but it is not a sales call. It is really a fit call, and hopefully we give you information that you can make a decision at that point. So on the theme of, or Jacob, sorry, let me let you kick this part off.
Yeah, no, we're just going to get into cost seg. So I think that slide number one is just going to be general information about it, and then I'll pass it back to you to get a little bit more context. But it's a beneficial specialty tax credit opportunity. It's a strategy, of course. It's used by commercial and residential rental property owners to accelerate depreciation. So think of exactly that. It's accelerating your depreciation, segregating the land value versus the actual building. It defers taxes and improves cash flow opportunities as well. I mean, we're talking about tens of thousands of dollars in potential savings. So definitely worthwhile looking into.
Totally. Well, then I'll get into the details. So I think the main point is that what we're trying to do with cost seg is break up the asset classes from the standard class, which is typically over a longer time horizon. So the concept of depreciation is essentially that you are looking at the annual cost of an asset, given that its life is longer than just 1 year, right? So if we're talking about residential, a lot of our clients are short-term rental hosts. What we're doing is we're dividing the property by 27 and a half. If you have a calculator out and want to do quick math, you can take your purchase price and divide it by 30. You do have to reduce the land cost. So there's some caveats to that, but that's essentially the annual deduction that you're going to get. What cost seg does is it allows you to break up different components of the building into shorter periods. So instead of 27 and a half, we're talking five years. And if you do that math quickly, you can see how a deduction of maybe 3,000 a year for a $500,000 property can turn into a $50,000 deduction in year one. So how do we take advantage of this, and why is it such a good tax strategy? Well, the IRS does require that an analysis performed. So you can't just do the analysis in Excel, hand it over to your accountant, and expect them to reflect that on the tax return. Today, tax professionals are aware of cost segregation and what they want to see, whether you file with us or file with another firm. They want to see that an analysis has been performed, that if the IRS ever questions how aggressive a deduction this is, that you can hand over to the IRS that something was done contemporaneously. And that means it was done at the time the tax position was taken to justify and support that deduction. A cost segregation study isn't just words and numbers put together. It is a very methodical document that, in our case, goes from 20 pages to 40 pages, explaining the methodology, explaining the classes, and explaining the tax code. For those of you that are clients, you may have seen this already, and you get a very quick sense that it's not something that you can do on a Saturday. Main concepts here: accelerated depreciation. What's happening there is you might end up with, let's say, 100,000 in 5-year property. Well, you can bonus that. So meaning that instead of dividing the 100 over 5 and getting 20 each year, with bonus depreciation where it is today, you can get 80% of that 100K today. So you can get 80,000 as a deduction by accelerating it using bonus. So right there, you just went from 5,000 in annual depreciation to maybe that 80 in addition to the other classes. Maybe you're talking about $100,000 reduction in income, which could be a major savings if you've already paid taxes with your W-2 income. So let's just say that you did pay 100K in federal income taxes. You can find that on your W-2. You can find that on your year-to-date statement. If you look at pay stub, you can see it'll say YTD federal income. You can see what that number is, and it's about June in the year. So if you double that, that's about what you're going to have sitting with Treasury when you file your taxes. If that number is pretty big, that is where you want to, and that you purchased a property in the last 3 years. Again, this isn't specific to doing it in this current year. That is where you're going to want to look at and do some math around what the opportunity is. So that's going to increase your cash flow. Let's say that you do get a deduction where you're getting 30,000 of your federal income taxes paid. That's 30,000 of non-dilutive capital that's not taxable. You've already paid taxes on it that you can use in the business. So instead of writing a check, which constrains your investable funds, you are now building capital in order to make future investments or keep cash on the sidelines. Tax deferral. So the concept here is that you are deferring taxes in the sense that once you sell the property, you will get depreciation recaptured. Now, someone might say, well, why would I do a tax strategy that saves me today that I have to pay tomorrow? And I will give you two answers. They can really be summed up into the net present value of money. But the first is inflation. A $30,000 tax bill today will be essentially $28,000 of today's dollars 1 year from now, given where inflation's at. And if you extrapolate that down the road, inflation makes your future debts less painful. So it's the same amount of money, it's just in future terms. And the second point is that you typically have cash upon sale, and you could do something like a 1031 exchange where there isn't a capital event. But just know that if you do cost segregation, that you are going to want to look at capital gains if you're going to sell that property and cash out completely. In 1031, we capture in different blog posts, and we'll likely do another presentation on it, where essentially you are deferring the capital gains by selling one asset and buying a like-kind asset. So just note that point on tax deferral. ROI, so cash on cash return. more cash back, and with the same amount of cash out, is going to increase your ROI. Strategic planning is just the concept that instead of doing something where you're filing your tax return every year and you're just getting your tax bill, cost seg falls into the world of looking forward and backwards even at all the opportunities that you may have missed. So cost seg is a great strategic tax plan option, because even if you file your tax return and let's say you bought this property in 2022, you still have the opportunity to do a cost seg study and roll forward your tax savings without amending the returns. You have to do a change of accounting method. That is filing form 3115, I believe. It allows you to carry forward the tax savings that you otherwise would have received 2 years ago. So there is an opportunity without a big administrative lift to play in a tax strategy from 2 years ago. And the second part of tax planning that makes this valuable is the ability to get active treatment of STR losses. And that's something that we talk about a lot. There's certain requirements to be the most active participant in your business. There can't be anyone else that participates more in the business. So if you have a property manager, it's going to limit the benefit a little bit. But if this is a property that you manage yourself or that your spouse manages, the opportunity is tremendous for you to offset those W-2 wages. And it's applicable for various property types.
You kind of touched on it, Miguel, but what if I'm sitting here today, Jacob filed his 2023 return, but I didn't do cost segregation? You did touch on it a bit. You'd recommend rolling that forward. Is it even possible to amend it and apply it for past year's tax return?
Yeah, you certainly could.
Could.
You can certainly apply for a refund or apply it in this year. And that's typically what we look at. And we always have that conversation with our clients. Hey, what's more beneficial? Did something happen to, a few years ago where we do need the IRS to update that balance? It could be that you're on a payment plan. Maybe you sold off your crypto at the height of, 2021. And, you've got this tax bill that you ended up going on a payment plan. If you do want to amend that year and reduce that tax bill, it may be better than just rolling it forward and getting it, months out when you file your 2023 tax return in October.
Got it.
Yeah, and here are just some key points on why we think they're a great strategy from Airbnb. I touched on one point earlier that if you can get that active treatment on your losses, and that's something we do for our tax line. It's actually something we've been doing for years. And I was listening to a webinar like in 2018, and I was like, this is the very first Airbnb. It's got like 18 views on YouTube, so it's nothing fancy, but this is the first webinar on Airbnb tax strategy, and we're talking about how to get active losses from STR rentals. It's all over, tax TikTok and Instagram today. But we were one of the first ones that understood this. And really, I look at some of the content that's coming out. I feel like we gave a lot of the talking points for some of the folks that are really blowing this up, that maybe don't focus on the industry, but they say, hey, we help, whoever buy STRs and then get that tax benefit. But I think one benefit of working the shared economy in particular is not only have we been doing this since 2014, we've seen audits, we've worked with IRS agents, we've gone back and forth on why this actually is a reasonable strategy, the differences with hotels, the lack of differences, and actually most notable in, I think, 2022, the IRS put out memo and guidance saying, hey, a lot of you tax folks are telling us this is different. A lot of you tax folks are saying the code doesn't address STR. So here's our guidance on how we're going to treat it, and it's gold. So it is a strategy that I think has been validated. It's one where I can confidently say we are leaders in the space. That said, I think we've still got a long way to go in terms of delivering kind of the way we want to with clients, but in terms of being technically sound, I would say that we're very confident that this is a great defendable strategy from an Airbnb standpoint. So I will say that there are certain cases where cost seg isn't valuable. If you are passive and you're planning on holding assets for, let's say you've got these assets in trust and you want to pass on your commercial or residential, I would say commercial residential property onto your kids or your grandkids, and you want to hold this stuff for 50 years, cost seg probably isn't going to change the outcome significantly. If you have, that said, if you have multiple passive income streams and you have, I think a lot of the times when you are a residential investor, or sorry, real estate investor, you have a lot of paper losses. That's just the nature of depreciation. If you've already got lots of paper losses, you're completely passive, you've got property managers, you want to hold properties for a long, long, long time, and you don't want to look at potential tax savings because you've already got this huge passive loss that you're just building up. You don't have the opportunity to bring it in and be active because you use property managers. It's probably not going to be as exciting an opportunity for you. But again, you can confirm those fact patterns. In fact, if you have a question about what I just said, feel free to ask. Happy to clarify. So some best practices, and actually, Jacob, maybe if I can get a quick break, maybe you can cover these.
Yeah. So when should cost segregation studies be conducted? File tax the same year as purchase. So once again, Miguel did touch on it a bit. It doesn't necessarily have to be. Correct me if I'm wrong, Miguel, right? You don't have to necessarily do the cost segregation at the time of purchase. You can always backdate it roll forward like we discussed, but typically that's going to be best practices. So just make sure you do keep that in mind. Study same year, ensure max savings. So just make sure that, yeah, of course, you do the study the same year to ensure that you do have those tax savings, excuse me. Align timing with peak expenditures. Miguel, will you touch a little bit on that third item? Just give me a little bit more context on that.
Yeah, absolutely. So I think the point is that we are better at keeping track of receipts in the current year than we are in the last year. And a lot of times, I think our client demo is a little different than, your buttoned up, white shoe CPA firm. We work with a lot of folks in the digital economy who are maybe trying this out. Maybe they're successful in business and now want to build wealth in the sharing economy. So we deal with a lot of, I would call it, startup investors who are going from, hey, I know how to run a business. Now I want to run my Airbnb the same way that I run my business, but I don't have the infrastructure, I don't have the support, I don't have the know-how. I would say that a lot of time when you are that, so if you are that where you just got started or you've got 2 or 3 properties, you're probably not tracking every expense the way you would as an executive in a big company. You're probably using personal cards, you're probably putting things down in Excel, and just being able to do it in the current year where that information is fresh is just going to allow you to capture more than if you've got to go back and
Okay. So is there ever a case where, let's just say, I mean, yeah, I think that's actually correct, right? Year one, you're typically going to have more expenditures than year two. So it would make sense to do it in year one. I kind of see what you're saying there. Okay.
Yeah. And then just ideal candidates, there's 2 types of cost seg studies, by the way. There's purchase, and then there's renovation or build. So, bullet point here is newly constructed building, you're going to want to do cost seg. The last thing you're going to want to do is just have the county inspection or the county appraisal be the depreciable value. I think, those are methods that are acceptable from the IRS perspective, but they're not going to give you the most aggressive tax strategy if you're just going by default, right? So you do want a cost seg study if you've got either a big renovation. I usually say when the renovation is over 100,000, that's when we should have a conversation. And then certainly on a full new build, you're going to want that analysis done. Existing buildings we've talked about, and then there's other industries that maybe aren't the subject of this conversation, where I think cost seg is really growing and fast. Build outs that are commercial or industrial. So and we have those capacities in-house. So we do 80%, 80 to 90% of what we do is in niche, but we do have, because we have clients that are business owners that have multiple investments, have portfolio of businesses, if you will. We do consider ourselves nimble enough that if you are building a facility, we have one client who is building a manufacturing facility in Ohio, and we were able to help them with a cost seg. So other fact patterns, other industries also are great candidates for how to be cost seg. And then, yeah, I want to bring it back to Crystal on these. So we talk a little bit about how long studies take on this slide. But yeah, I'd like to kick it over to you, Crystal, to make 2 points. One is, how long does the overall study take? Can you speak to the process? And then folks want to know, how long does the on-site review take? So if you can speak to both of those, it'd be great.
Perfect. So the easy one, and now that my camera's back, the easy one is the on-site interview. Depends on the technology. So it also depends on your property. If you have a typical home, I'm going to go through it fairly quickly. I'm going to ask you questions because there's some things that I can't see based on pictures. So is it, are your cabinets hardwood? Are they a laminate? What type of flooring do you have? There's really good vinyl flooring now that looks just like hardwood. So you might not know the answer to that question, and then I'll walk you through feeling it and we can figure out what it is. Typically, it's going to take about 45 minutes to an hour for a normal residential property. If I have a lot more questions, it leans more towards 60. If it's a very large house or something with a lot of high-end details, we're going to be more into the 60 to 90 range. Just because I'm going to make sure that I have all of those factors in there because it changes the way that the depreciation is going to go. In terms of the report, it can take anywhere from 6 to 9 weeks. It depends. Sometimes there's a little bit of back and forth with the homeowners on getting the information that I need and then plugging it into the software. We do have an in-house checks and balances where the reports are going to get reviewed beforehand. So we just need a couple of weeks to get the reports nice and buttoned up. And after that, it's smooth sailing.
Yeah, very good. And I will say, as a part of our process, one thing I do want to highlight is that we will do a very high level ROI of doing cost seg for you. Meaning, what's your AGI level? What is the total purchase price? And Crystal, what do we need? What are some things that we need in order to get started with that ROI, and then B, what would you like before that site visit?
Yeah, so right off the bat, as we're usually doing this for newly purchased properties, that appraisal is key. We do have a question from one of the attendees about determining land value. So there's different ways we can get it. Typically, the appraisal is going to give us the land value that was used for your appraisal. Is it always correct? No. I usually check it with county records, but it's about having a defensible position. So if the IRS comes calling and I say, oh, the land's only worth $10,000, they're going to want to know why we use that figure. So if we have the county records or your appraisal, then we can defend why we used our land value as whatever figure we put in the report. And then other information, like I said before, we're going to want links to your Airbnb if that's the property you have. If you have a floor plan, I do need square footage. So either we're going to have to measure it together, which is super easy, or I'm using the measurements from your appraisal or your floor plan. So those are the big things. If I don't have a floor plan or some sort of measurements of your property size, that's going to be the big chunk of the site visit, is us having to take measurements. Or we can obviously do it separately, and you can ask me questions, but that's a big important part of the process.
Very good. Thank you, Crystal. So I think on average, we were saying it's common to finish within 60 minutes. And then in terms of the cost seg report, I just want to highlight that we are trying to work through having a draft really for the tax return. There is a finalization process where, if one of the tax partners has to review, it's just going to take a little bit. But we want to get to the draft because once we have the draft, we'll have the schedules to put on the tax return. So just something to note that if you are looking at that extension deadline that is October 15th, typically we don't have short-term rentals in C corps or even S corps, but there's a reason for that. If you did, that deadline would be 10/15, but typically if it's in a partnership, partnership LLC, that deadline's gonna be 9/15. So as you kind of rewind the date, if you're in a partnership, for example, you definitely want to get started on that cost seg study in July. July is a good time. What's going to happen, yes, for those of you that have worked with us or that follow, is that folks don't usually want to get started in summer. Kids are off to school, you're going on vacation, and then you want to get started in August when we are ramping up and spots are limited and we're negotiating on whether we can get your return done. It's never a fun conversation. We always want to say yes, but we also want to under promise and over deliver. So to the extent that you want to have a conversation, I would say June, July, you're going to get a lot of our best attention and energy. It's a good time to connect if you're hearing things that make you interested in moving forward. Well, let's move forward to closing thoughts, and that way we can get into some questions. So, and feel free to ask questions. There are no dumb questions. Actually, the simpler the question, I think the more we appreciate it. So just to wrap, closing thoughts. We're talking about tax savings at the end of the day. This isn't a study that you're going to enjoy to read. I usually tell my clients and other investor groups that if you get tired, if this is good sleeping material for reading our studies, we've done our job. The audience is the IRS. It's not supposed to be riveting. We want to make sure that we've done our job, cover all our bases, and that means we are slowly getting to the point. In terms of what our investors see, our clients, we're typically just looking at the depreciation schedule, which gets reflected on the tax return. So walking through a cost seg, pretty straightforward. If you want to understand the whole thing, block out some time before bedtime. But the real reason we're doing it isn't for the deliverable. It is so that you can take a strong tax strategy with the proper defense behind it. Work with a professional. We brought on Crystal, who is a former appraiser. There's questions I've heard her ask on calls that I would never think to ask, from the material of the carpet to things that are in crawl spaces that I had no idea were in crawl spaces. You want to make sure that you've got someone that either has an engineer or someone that understands the ins and out of understanding the makeup and valuation of a property, along with a strong tax side, which we have, that can translate that onto a tax return. We actually had, we brought recently, Jacob had an onboarding call with a high profile now client who had a cost seg study done, paid all this money. They did the on-site interview, really excited to get that tax benefit. And when we looked at the tax return, it wasn't even filed on the return. So they did all the work. So it's really, I think, challenging too when you've got to coordinate a different cost seg study firm with your firm. So you want to make sure that you've got two parties that have synergies, and we're rolling that out in the offering by doing the cost seg studies ourselves. And then I think we do it because it's smart, but make sure that it's smart for you. Make sure there's a conversation and you've got some kind of ROI analysis on what the cost benefit is. It's too hard to do on this call. I think it's really hard to generally say income and expenses that make this make sense, but typically I see an absolute tax benefit even when properties are in the 400 range. So if you're a little below that, I think there's still an opportunity. There is a cost associated with what we do. I will say that our studies start at $2,000. There's a deposit component and a final component when we finish, but $2,000 for $100,000 in reduced AGI is a no-brainer. But we're happy to prove it out so that you're comfortable before you move on. So let's get to our Q&A. Jacob or Lucy, do you want to pick and choose questions to throw at us?
Yeah, sure. Let's see. So I think the first one I saw was from Dennis. What if you have a duplex that you lived in, and also Crystal, I don't know if you answered some of these, but I was just taking note of them. So from Dennis, what if you have a duplex that you lived in and rented out the half straight line depreciation for 3 years? Can you move out, remodel the second part, put it on Airbnb and cost seg to accelerate the depreciation? Will it start from 2024 cost basis after accounting whatever is already depreciated? So loaded question there.
Yeah, I think there's a few things in here. And the first thing I'll say, so again, I have to take out the general. So Dennis, happy to connect, but I have to kind of extrapolate a more general question in order to make sure I'm answering it right. Otherwise, I'm missing a lot of context about your specific question. But on a general level, the asset needs to be a business asset. So for folks that kind of live in the upper level and rent out the basement. We can't do cost seg. We can still depreciate the component that is business. So, duplex where you've got a split unit, A, B unit, can you cost seg the B unit? It depends. I think that's really going to be a conversation. And then when so let's say, so I think, and then the complexity comes in. If you move out of the whole thing, now you've got a whole business unit. Do you cost seg the whole thing? I think it depends, but, in some sense, placing it in service for, full business use. Let's say that happens January on 2024. Yeah, that's a fact pattern in which looking at doing a cost seg for the whole thing, it's completely for the business. You can prove that it's been fully rented, fully available on a short-term rental platform. You've got a case for cost seg. So again, I didn't mean to. No, I did mean to construe your question into something else. I just have to, hoping we can connect to get into the context and leads.
Exactly. No, I think you did a good job on answering that. And then for E, what is the minimum earnings needed in income and property value and expenses to benefit? And this is not saving taxes, rather delaying them, correct?
Yeah, so a few questions in there. So I don't think there's a minimum income or expense. Like I said before, it has to be a business asset. So the assumption here is that this isn't, your inherited cabin that you stay in 5 times a year and put on Airbnb during the summer. This is a business asset that's been placed into service. So the P&L can be what it is. I think typically, again, you're going to have a small level of income depending on how you run the business, or you're going to have a paper loss. So that's going to be what it is. I wouldn't focus on that. That doesn't change the opportunity on cost seg, because cost seg is going to drive up the deductions, drive down the income significantly no matter where you are. And then in terms of tax savings, like I said before, it is a realization of tax savings that you may or may not get later. So bonus depreciation, for example, is 80%. Next year, it's going to be 60%. So the idea that you're going to be net even on a net present value of money basis, it would be incorrect. The value of having $30,000 today versus potentially, $20,000 3 years from now is going to highlight that you'd rather have the cash today, right? So tax rates might change. Like I was saying, bonus is phasing down. So the benefit of cost seg is decreasing. And that's a real threat to the industry, by the way. That, cost seg might not be as juicy in, I think 2026 or 2027 is when bonus depreciation fully expires. So it's 80% this year, it's 60% next year, 40%, 20%, and goes down to zero. So the ability to accelerate depreciation is going away. So there is onus on putting these strategies in place now before later.
Gotcha. And then Dennis has another good question. If you do any remodeling after the property was already placed into service and straight line depreciated, will those repairs be included on the cost seg study? If you do it this year, or they have to be on a separate depreciation schedule?
Um, Yes and no. I think the way that the industry does it is they do different cost seg studies. So there's one for purchase and there's one for the renovations and improvements. They go on the same depreciation schedule, but they are different depreciation line items.
Mhm.
That might be too much of a technicality, but that's a really good question.
Yeah.
And then the second point, I don't get. I was just reading it. Probably more of a conversational piece than a question. So, yeah, unless there's any other questions, I think we can move forward with how you connect with us. So I think we've had the QR code on how to connect with us to specifically discuss COSEG and how to sign up. And then if you want to look for other ways, and feel free to ask questions here while we wrap. But if you want to connect much faster, we are sharing Jacob's email here on the screen, as well as a landing page down to Twitter. So if you just want to follow what we're talking about, not engage, look at the bottom. If you want to talk to someone right away, look at the top. And again, we're happy to connect. That's what we do during summer. We educate.
Mm-hmm. Yeah.
So
And you guys have any? Oh, go for it, Miguel.
I was just gonna say, Jacob, do you want to take the last word? And
I always want to. But yeah, no, thank you guys so much for joining us today. We always love to do this, provide you guys some good, free material. So yeah, like Miguel said, check out our socials. We're really trying to make some good pushes there, give you guys some good information. So follow us on Instagram, Twitter, or X, I guess nowadays. You have any questions, even if you do not want to engage, no worries. Of course, you can always reach out to me. I can always give you any other, context that I have for you. So yeah, reach out to me directly, Jacob at sharedeconomycpa.com. Kyle, I saw that you had a good question. Yep, we're gonna take care of you. Go ahead and reach out to me directly. We'll jump on a call together. Yeah, that's all I got for you guys. Thank you so much for coming along. Crystal, thank you so much for joining us as well. Always nice to have a new member on our webinar series. Miguel, thank you as always. I got nothing else.
thank you, Jacob. Thank you, Lucy, and thanks for everyone taking time out of their day. Cheers.
Mhm.